With the current market events that are going on, I thought it would be appropriate to talk about a refresher as to why we invest and how our emotions can both positively and negatively affect our investment decisions. Good morning, my name is Paul Carroll. I'm the CEO and founder of Efficient Wealth Management, a boutique wealth management firm based here in the Woodlands, Texas. When we talk about investor, we need to talk about investor discipline, because discipline is sorely tested in environments like today. We know 5 things about investor discipline. We know that humans are not wired for disciplined investing. Many investors follow their emotion, if not most. Reacting during periods of market duress can significantly hurt performance. Markets reward discipline. And finally, what can we control? Whatever it is we can control, that is what we should be focusing on. We talk about humans not wired for disciplined investing. There are a lot of mental heuristics that exist, and we're feeling them now. The market tanked, and I should have seen it coming. I've got a proven system. I can go to Morningstar and find the 5 stars. My research, the sexy story sells the stock. I knew it was going up. It was a bad idea. These are all mental heuristics that all investors suffer from. And even myself, I have to fight these, because hindsight truly is 20/20 in the investment world. When we follow our emotions, when we follow our gut or instinct, what happens? We see this cycle again and again and again. Optimism, elation, nervousness, fear, and back to optimism. Right now, we're pretty close to the fear part of the cycle. If we cannot divorce our emotions from what's going on outside and from our investment decisions, then what we end up doing is buying high and selling low, which the last time I checked is not a formula for success. Reacting can hurt your performance, and I'm going to show you a couple of things here. If we look at the performance of the S&P 500 from 1970 to 2014, we see that the annualized compound return was about 10.5%. What's important, though, is if you miss the one best day per year, you drop down to 10.2%. If you miss the 5 best days of the year, you're down to 9.4%. If you miss the 25 best single days, your 10.5 has dropped to 7%, just 2% more than 1 month Treasury bills. And this is the conundrum. Many of these best market days are right after a period of extraordinary fear and negative market movement. So let's talk about how markets have rewarded discipline. If we look at all this bad news and we look at this long term, what do we see? We see $1 in 1970 going to $45. None of these events, none of them, resulted in permanent market damage. And what this picture does not show us is how rebalancing would further improve. And the reason I bring this up is we look at the subprime mortgage crisis. It took the market a good 5-6 years to recover, but it took a rebalanced portfolio just 2 to 3 years, depending on the asset allocation. We said briefly, focus on what you control. And what we can control is the risk tolerance in terms of finding that investment plan that fits our risk tolerance. Structuring the portfolio so it maximizes the value bias, the size bias. We can adopt the benefit of momentum, managing costs, managing broad diversification, and minimizing taxes. You can't reliably forecast what's going to happen next, but we don't really need to. You see, picking the winning stock is like picking the fastest lane in traffic. It's very hard to do, it's rarely successful, and it creates undue anxiety and risk. So how have the capital markets rewarded long-term investors? If we look at the growth of a dollar from 1926 to 2014, we see some interesting things. One, inflation. A dollar is now worth $13. Treasury bills are barely worth any more. In fact, after tax, they're worth less. Long-term government market bonds have actually done fairly well as interest rates have fallen since 1982. But I think it's fairly safe to say that party is over. And if you look at the pre-1982 green line here, that's what you're going to be looking at going forward. But when we start looking at U.S. large cap, then even better, U.S. small cap, look at the phenomenal growth that you get from owning investment and assets. What do I mean? I mean equities, not debt. And what about diversification? Diversification does a number of things for us. It helps us capture what the global markets can offer by diversifying globally. It helps us reduce our risks. It helps prevent missing opportunity. Though sometimes diversification means we're exposed to negative opportunities in the short term, it also helps smooth out the bumps and takes the guesswork out of investing. There's always this implicit desire, though, to outsmart the market. When we talk about that, one of the things that most investors don't realize is when we look at the historical benchmarks, those benchmarks are benchmarks of survivors. And even with survivors, it's very hard to beat the averages. But if we look at funds for the last 15 years, equity funds, you can see here at the beginning we have all these funds, but the survivors are significantly less. And the winners, that portion of the survivors that have won, are only 19% of the funds that began. Same with fixed income. Of the initial funds, most are gone, or many are gone at least, and only 8% survived and beat the benchmark. So we don't try to beat the benchmarks, we try to improve on the benchmark through smart beta strategies, through the dimensional investing strategies that are available. Diversification has to be global for a number of reasons. First and foremost, the United States is only 52% of the global equities market. Second, we're a mature market. The growth rate of some of these developing and emerging markets is phenomenal over time. And it brings us to a very important topic, and that's what's going on in China and how significant is it. And I think this chart tells us what we really need to know. China is only 3% of the global equities market. Greece is less than 1%. It's insignificant. And we're seeing, maybe today as we record, we're seeing markets snap back as they realize this isn't good news, but really 3% of the global equity market? And even if we bundle in all of those emerging markets, of which about 50% are significantly exposed to the Chinese equity debacle right now, it's still a small part of the global equity market. But diversification is important, not only on an international dimension, but also on an individual stock dimension. A number of our clients have significant holdings in United Airlines, Schlumberger, Halliburton, Exxon. And they have discovered lately, especially if they're in the energy industry sector, how significant concentrated risk can be. Diversification reduces the impact of any one company's performance on your wealth. If you work for one of the major oil companies, you know in the last 6 months, that portion of your portfolio that is married to your employer has had significant damage. Now, sometimes you can't do anything about that. Sometimes because of stock options or some other form, restricted stock, there's nothing you can. But to the extent you can, you should constantly be diversifying sole company holdings. Diversification also prevents you from missing opportunities. Identifying tomorrow's winner is really much a fool's errand. And the problem is, if we try to do that, the odds are very significant we're going to miss out on some of the top 25%. And if we look at all the stocks from 94 to 2014, we're looking at 7.5%. But if you take the top 10% of those stock performers, which are disproportionately value-oriented stocks, now your returns are only 3.2%. And if you take the top 25%, 75% of the equity market lost value. So really and truly, unless you know for sure who, what, where that 25% is, you must have global and total market exposure. Diversification also helps us today while the markets are correcting. Because today what we're seeing is significant pain across many, many markets. But those clients who are significantly diversified, though they've watched as the S&P 500 went up on its own for 3 years, and maybe the rest of their portfolio, it grew but not as attractively, now they're sitting on the sidelines going, oh, thank goodness. Because nothing got hit harder than the asset class that did best over the last few years. We call that regression to the mean. Diversification helps smooth out the bumps. It leaves us frustrated on the upside, but on the downside, it saves the portfolio. And finally, diversification takes the guesswork out of investing. If what I've got here in this final chart are the returns of various asset classes in different years. And I'm not going to dissect this, only to show you that in 2008, the S&P 500 was minus 37%. In 2009, it's plus 26%. In 2011, it was only 2.1%. International small caps were minus 14%. Yet in 2012, they were 18%. In 2013, 26%. The point? It really is hazardous to your financial health to think you can truly outsmart and outguess what's going to happen next. And our recommendation is, if you were comfortable with your asset allocation a month ago or a year ago, then if anything, you should be more comfortable now that these asset classes have revalued. So our recommendation is to continue with your existing asset allocation. Quit watching the news. This too will pass. I wish you the best of investing success.